Now, we have the next part of our OCBC House View video series, where we discuss macroeconomic developments from developed markets, Greater China, and the ASEAN region. With us today, we have Selina Ling, Chief Economist and Head of Global Markets Research and Strategy here at OCBC, and Lavanya, Senior ASEAN Economist. So Selina, could you take us through some of the key themes and developments that have been occurring throughout the global economy and Singapore?
The global risk appetite has actually improved due to increased hopes of a global soft landing. However, the headwinds remain familiar, particularly the recent developments in the Middle East. So we have upgraded our US GDP forecast for 2024 to 1.5%. This still implies some moderation in growth momentum in the second half. Overall, US economic exceptionalism continues at this juncture. The US economy remains a bright spot among the developed markets. And this explains why the narrative for the expected Fed rate cuts has actually shifted substantially since the start of the year. Outside of the US, growth in the Eurozone remains muted, while China's recovery is likely to stay bumpy. For Asia, the first quarter growth cues have actually been somewhat mixed. Those benefiting from the AI tech boom are actually faring better than those dependent on consumer electronics such as PCs, etc. Domestic demand is relatively stable, but the manufacturing recovery is still patchy. Tourism numbers generally continue to improve. However, Chinese visitor arrivals are not fully back to pre-COVID levels yet. For Singapore, advanced estimates of the first quarter GDP growth came in slightly below expectations. We retain our full year 2024 GDP growth forecast of around 2% on the expectation that manufacturing, especially electronics, will stabilize and improve in the second half of this year. This will be an improvement from the sluggish growth that we saw last year. Cost of living concerns remain pertinent even though headline inflation is subsiding. MAS is likely to remain in a prolonged pause mode as core inflation may only subside more significantly in the fourth quarter, going out into 2025. Notwithstanding the upcoming leadership transition, domestic policy continuity is likely to sustain.
Thank you, Selina. Now moving on to ASEAN. So Lavanya, what are some of the key updates to our ASEAN views for second quarter 2024 and onwards?
In terms of the ASEAN economies, the growth story has actually been relatively resilient for 2024, and we expect it to remain that way for the rest of the year. However, our monetary policy calls have changed in line with our upward revision to our global oil prices, as well as the change to our US Federal Reserve call. In light of the fact that the US Fed, according to our house view, will now only cut its policy rate 3 times this year versus 4 previously, and start in Q3 versus June previously, we have changed our calls for Bank Indonesia, Bangko Sentral Nik Filipinas, and the Bank of Thailand. For Indonesia, Bank Indonesia surprised the market and our expectations by hiking its policy rate by 25 basis points at its 24th April meeting. The hike was aimed to stabilize the dollar-rupiah exchange rate. The rupiah has been under some depreciation pressure recently, with the dollar-rupiah exchange rate trading at around 16,200 levels for the past 2 weeks. BI also said that the hike will preemptively mitigate against imported inflationary pressures. The question now going forward for us is, what does BI do next? Does it hike further, or will the next move be a cut? It is a close call, and we have not ruled out rate hikes, but our baseline is still for BI to remain on hold in the coming months. We do believe that the trade-off for BI is getting more intense in terms of its growth inflation dynamics versus managing external stability. Our own forecast is for GDP growth to slow this year to 4.8% as commodity tailwinds fade and some slowdown in investment spending takes hold. However, we also expect that inflationary pressures in the coming months will remain volatile, especially because of volatile food prices. That said, we do expect headline inflation to remain within BI's 1.5 to 3.5% target range for the rest of this year. One of the key reasons for why the IDR has been depreciating has been due to external factors. And until we see these external factors change materially, we cannot rule out further depreciation pressures in the IDR. And to that end, we cannot rule out further rate hikes from BI. However, as we mentioned, because we think the trade-offs are getting more intense, our baseline is still for BI to cut its policy rate rather than to hike as its next move. we now expect that BI will cut its policy rate by a cumulative 75 basis points this year, backloading most of the cuts into the fourth quarter of this year, followed by another 50 basis points in cuts next year. The cumulative 125 basis point in rate cuts is similar to our previous forecast. However, the timelines have shifted, and it is possible that the magnitude of these rate cuts will also change depending on the timing and the magnitude of the US Federal Reserve cuts. Moving on to Bangko Sentral NIC Filipinas, the biggest bugbear for the BSP this year has continued to be inflation. The disinflation process has been bumpy and volatile, much to BSP's disdain, and it has made the BSP remain quite hawkish in the two meetings that we've seen this year. As such, we now see the BSP being comfortable with a rate cut only in the fourth quarter of this year, and we forecast a 50 basis point rate cut in 2024, with the remainder coming in 2025. For the Bank of Thailand, we have removed our rate cuts for this year. We do not expect BOT to cut its policy rate for two reasons. One, we do not see the negative headline inflation print as being reflective of a weak domestic demand story. It is more a reflection of government policies, which we expect will gradually change to reflect higher headline inflation in the coming months. Two, we expect that GDP growth will pick up starting in the second quarter of this year as more government spending comes online, and by the fourth quarter to improve more convincingly as the digital wallet program is approved. As such, the need for rate cuts is significantly reduced by the second half of this year when the US Federal Reserve starts cutting its policy rate. In terms of the State Bank of Vietnam, we have not changed our forecast. We continue to expect SBV to cut its policy rate by 50 basis points this year, likely in the fourth quarter. And similarly, for Bank Negara Malaysia, we expect BNM to keep its policy rate unchanged at 3% in 2024 and 2025. The biggest unknown for BNM is the timing and the mechanism of targeted fuel subsidy introduction by the government. The government has said that it will introduce targeted fuel subsidies by the end of the first half of this year. BNM will be cognizant of the second round effects of the policy announcement as well as the pervasiveness of inflationary pressures. If there is a need, we do not rule out the necessity for rate hikes in order to address these. However, this is not our baseline.
Thank you, Lavanya. Next up, we have Tommy Sia Dongming, Head of OCBC Greater China Research, to cover themes that we're looking out for in Greater China.
As highlighted by my colleagues, the outcome in the Middle East remains binary. In the ever-evolving financial market, change is the only constant. Despite this, when it comes to our key coverage, our outlook for the Chinese market remains largely unchanged. The Chinese economy exceeded expectation, growing by 5.3% year-on-year in the first quarter. However, there's no light at the end of the tunnel for China's property markets. China's property sales by value experienced a significant decline of 27.6% year-on-year in the first quarter, while the fixed asset investment contracted by 9.5% year-on-year. Property sector is likely to remain a weak point in the near term. There are two questions arise from here. First, can the Chinese economy achieve its growth targets without heavy reliance on the property market? The latest first quarter data suggests that this is indeed feasible. This robust expansion in the first quarter was underpinned by several factors, including the resilient industry activities, strong service consumption, and a rebound in the external demand. The second question is, will this strong data deter China from further easing? We don't think so. Here's why. Despite some initial indications of recovery, recent inflation and the credit data continue to reflect an uncertain outlook for the domestic demand. China's GDP deflator, estimated to be more than -1% in the first quarter, has remained negative for the fourth consecutive quarter. Given the uncertainties surrounding both domestic and external demand, we believe that the strong data is unlikely to deter further monetary policy easing. So we still expect China to cut its loan prime rate by 20 basis points, although the timing of the rate cut may be slightly delayed.
Thank you, Tommy, for your updates on Greater China Research. All right, so that wraps up our updates to our house views for the macro research team. Thank you.